Welcome to the National Bank of Fujairah Knowledge Series event. My name is Gavin Kwass, and I'll be the host for today's event. After the successful relaunch of the NBF Knowledge Series last year, we are pleased to be back once again with this in-demand session organized in partnership with Refinitiv, a London Stock Exchange Group company. This event is part of the National Bank of Fujairah's knowledge sharing efforts and will run throughout 2023. The theme of today's event is corporate tax in the UAE, most likely the biggest legislative development in the UAE in 2023. In today's event, we will speak about the outlook for the UAE's economy and explore the implications for businesses ahead of sweeping reforms to the country's tax regime. We hope that you will take advantage of today's sessions to interact with our speakers and to network with other industry peers. Without further ado, I would now like to invite the National Bank of Fujairah's Deputy CEO, Mr. Adnan Anwar, to share his thoughts with us. Adnan?
Thank you, Gavin. A very good morning and very warm welcome to all of you. It's indeed always a pleasure to be amongst you people, and it's heartening to have you here. We appreciate also you taking time from your busy routines and to be with us today. We deeply value the relationship and the partnership which we have cultivated with you people together. And it is indeed one of our core brand attribute. And hopefully, we all share responsibility between ourselves to help each other. So NBF Knowledge Series to us is a platform to share ideas, experiences, to learn from each other, and hopefully to contribute to each other's successes. So we hope and encourage all of you to make today's session very interactive. We have an esteemed panel of experts. Hopefully, they will have answers to all the questions which you have. I could already make out from the participation and attendance, this is quite a hot topic, and you all have interesting questions which you shared with me earlier. Let me also take this opportunity on behalf of NBF to thank all of you for the ongoing support that you have offered to us, which led to a very successful last year for NBF. So in 2022, we as a bank achieved our best ever operating performance. So thank you very much for all the support you have extended to us. You will also be pleased to know that as part of our service-based focus and partnership, our ongoing efforts have been repeatedly recognized by external awards. And last year, the Middle East Finance Award, NBF was named as the best commercial bank, best SME bank, and as a best trade finance provider. So this means to us that we owe to you people to keep improving our services much better than anyone else in the town, and keep up our service offerings to you people, which we are committed to improve. As we know, the recent years have all been about uncertainties and the constant change, which we all have been grappling with. Whether pandemic, unprecedented times, we all overcome those. And Dubai and UAE was one of the best to handle that. As if it was not enough, followed by unfortunate events in the form of Russian-Ukraine war, now inflation, high interest rates, many things to grapple with. It becomes significantly more important for us to be on top of these things as we navigate through these challenges. Being close to UAE, being able to call UAE as a home has been truly a blessing. The UAE has managed these things much better than any part of the world, which is evident from an impressive turnaround last year, where estimated real GDP growth was more than 6%. So that is quite impressive. So Today's session is more about touching on the corporate tax, which was introduced by the Ministry of Finance last year. The date for implementation is very close. There are still open questions, and we thought an event organized on this can help us and yourselves in your implementation journeys. So I hope you find this session insightful and interesting, and try to benefit, try to make it interactive. And I wish you a very pleasant day. And without further ado, I'll give it back to your MC, Kevin, to start the formal proceedings. Thank you very much.
Thank you, Adnan. Some insightful comments there that I'm sure a lot of you can feel has been happening over the last couple of years. So let's start with our very first presentation of the day to provide an update on the economic outlook, including an overview of the UAE economy. Our speaker for this session is Nikita Pavlov. He's the EMEA Director for the London Stock Exchange Group. Nikita has multiple years of experience in various countries across the EMEA region at the London Stock Exchange Group. He joined the company with an impressive background in economic and financial research. Mr. Pavlov, if you can join us on stage.
Hi, good morning, everyone. Sorry, that was too much. Hi, good morning, everyone. Thanks for having me. If you don't mind, I will stay on that stage and not moving like on the TAD presentation usually people do. But with regards to TAD's presentation, I have a question for all of you. What do you know about 2023, which is already there? And actually, that would be the main part of my presentation today, to show you what we as a financial data provider know about that year. And actually, before I turn to the slides, frankly speaking, over the last 20 years, I barely remember just 1 year when I see so many theoretical black swans. We're literally in the middle of the lake, full of black swans around us, but that's also an opportunity for many of us. We're going to speak today about multiple topics, but whenever we need to analyze a year, actually, we have to start with the macroeconomy data. And if you look into the chart, it's actually the first theoretical black swan. If you remember 2008, Fannie Mae, Freddie Mac in the United States, does 2022 December looks the same? I believe it might, but there are also so many positive signals around that. Yes, key rates are growing, developed markets struggling with it, and it also pushes inflation to the high. Meanwhile, emerging markets are back to the agenda, and many countries expect double-digit growth of their GDP. Meanwhile, wage inflation shows slower temps than consumer price index. But what the most important there, that just recent data from employment market of United States shows that actually the jobs, or better say unemployment rate, is coming back to the pre-pandemic level. So that's very mixed signals if you think about that broader, because from one point you have high inflation, high rates, high pressure. From another side you have less unemployment people. And actually that might cause that revise of the inflation in the United States show for the last 6 months. 2 weeks ago they published that data, and that was one of the biggest surprises, because for those of you who are looking for that data, the last time so huge revise, and it's been revised from 6 to 8%, it's actually happened more than 2 years ago. For our economy, for our GCC, for our MENA market is also important the commodities market, and on the right-hand side you might see the chart is actually properly stating that when we see copper as a top performer of the return since the beginning of the year. Meanwhile, financial indexes stay somewhere in the middle. And actually, let me quickly brief you through that chart. So, from the positive side, and we will come back to that, Morgan Stanley just recently, a few days ago, ups their forecast of the oil consumption for 2023 by 36%, which is again very well expected after the pandemic because more flights, semiconductors issues in Taiwan is about to be fixed, more car producing, again more oil consumption. At the same time, China just recently stopped their zero COVID policy, which also triggered or boosted their demand on the coal from Australia. At the same time, if we see the silver on the bottom, and you might be surprised why it's so low, but actually for those of you who are looking into that market, that was a proper rally since September last year, and I believe that it's just the cooling down of their performance since that time, because obviously, no, I couldn't say at least one instrument could unstoppably grow. It has to be some stop point at the time, and I believe that's actually what's happening with silver, and the Brent oil price is actually doing the same, but it's still stable, and we will speak about that in a second. That's the pyramid, and actually, that's the main slide of my presentation. There will be a few more, no worries. But that's actually the proper trajectory, because whenever we see on the news that key rates are high, okay, so what does it mean for us? But literally, it's impact the real markets quite dramatically, because it rises inflation, but it comes to the liquidity and volatility. Because in the time of the low key rates, any corporate might easily go to the bank and say, okay, I need money, that's okay percentage, 0.1, 0.5 to rise my business. And now at the time when you analyze that you need to borrow money and current key rate is 4 or 5%, most likely you will not go to the bank, or you will spend that money more carefully to be sure that return on investment definitely will cover the coupon payments and your land. And definitely it comes together to the real market impact, but again, from the both sides. From one side, that's a rise of prices. From another side, it is just mentioned before, corporate, small companies, they pay much more attention to the money they have. That means they invest better, more accurate, they develop better products, and in the end, it's a more value for end users. So literally, that's pyramid for me is the main picture of how I see 2023. That couldn't be bad or good, it's both. And it's up on us how we treat that year, how we use that opportunity to move further along the year. Speaking about global investments, over the last 3 months, actually, I visited more than 10 countries, spoke with more than 100 partners of our company across the globe, and that was a very interesting meeting in Austria, where one of the bank, actually, they literally involved sustainable metrics as a part of filter for the companies to give them money. And that's a proper EU regulation, which is already impacted the whole Europe market. And just Friday, I came back from South Africa. And one of the largest banks there is actually thinking about the methodology to implement the same, to be sure that their customers are not doing something good for themselves, but they thinking about sustainable economy, they're thinking about the future. And for those of you who has interest in South Africa, you know how important that for that country, specifically nowadays with the blackouts, because people stay 4 hours per day without electricity. They have to buy electricity from neighbors, but at the same time they're selling that. But again, if you want to speak about that more, we could do this over coffee break. And the UAE actually, for me, is the key market for this year again, because COP28 going to happen November this year in Abu Dhabi. And if you look across Dubai, and actually the Burj Khalifa, the building stays next to that to us, if I recall correctly, it's 35% actually has proper sustainable technology. It means that cooling water, it comes from the not carbon sources. That's very important. And actually, if as a company who has a lot of financial data, now we see more and more requests from private equities who wants to distribute their data to us to be visible for global investors. And speaking about global investors, actually, that's the next slide. And some of you might be questions why it's all growing, why it's all positive. But that's fund flows. It means inflow minus outflow of the global funds mutual funds, ETFs, and as you could see during the last few years, 5 exactly, it's actually show only positive dynamic. It means the global investors prefer to spend more time as a passive investment into the sustainable funds. And actually the green line on the slide shows that number of funds are growing rapidly. It means that many companies such as BlackRock, Vanguard, PIMCO, many mutual and wealth fund managers actually now establishing the new way of funds, sustainable funds. And we now have an excellent opportunity to be on their radars if we follow that initiative. Speaking about us, let's come to the mini market. And actually that's the forecast. Again, I specifically put red and yellow lines over there, just not to be overly optimistic. That's the oil price analysis until 2027. And as you could see, the median and mean stays around $80 per barrel. But there are still some people who say it might be 60 and it might be 135, which is an excellent news. But again, as I said, 2023 is very contrast year. It couldn't be just bad or just good. It's both. I strongly believe that we stay across that median level. And actually, if we even think about the post-pandemic market, you could see the spike in Q3 2023, and that's exactly that's post-pandemic expectation from the market, and then theoretical slowdown, and then it goes up again, but median stays the same. So we have to feel ourselves quite confident from that perspective. Moving to the next slide is our GCC indexes. The top performer one is Egypt index, again, for very well-known reason. All the rest stay the same. But what's most important on that slide, the dividend yield averaged is 2.3%. What does it mean? In the world when you have key rates on the level above 4% and your dividend yield is 2.3, equity is not the answer anymore, at least in the current circumstances. Because if you have a year horizon of investments, you would rather go for fixed income with a fixed coupon, have a payment across 5%, quite guaranteed, instead of taking the risk of equity with a dividend yield, if you not expect some big growth out of them. What I'm trying to say, that's actually the market of debt, and that's not only bonds, that's also loans, is now much more important for global investors. And again, it's very much correlate with what Europe banks are doing, what South African bank, one of them are doing right now, that it might be a new industry for all of us. The name of that slide is rates, but none of the data show the rates exactly. It actually shows probability of default and ESG country score. I specifically I put Egypt on that slide because it actually shows two main things. COP27 happened in Egypt, but meanwhile, probability of default over 1 year horizon stays above 80%. And at the same time, Egypt has the lowest ESG score by our methodology. I'm not saying that there is very straight correlation about that, but it's one thing to keep with you after that meeting. Does it matter? Does it important? I believe so. But for the rest of the countries, in terms of probability of default, again, GCC market stays as one of the safest one. And that's actually the main topic of our today conference about the taxes. So our market is very much attractive, not only from the business we're doing there, but from the macroeconomy landscape as well. And the last slide, and with few of you, we had a chance to speak before the event today. I'm not a politician, but the behavior of Great Britain pound is actually getting worse over the years. And my boss, he sits in London, and I will just quote him. Seems like the Brexit was the most stupid decision UK ever did. And now it's impacted not only economy, but real market. That's not my words, blame my boss. Meanwhile, euro and US dollars are doing stable, if we couldn't say great. So their indexes shows stability, and US dollars is actually compensating the spike we had in Q3 last year. That was my last slide. I will stay with you for the whole day today. So just in case you have any questions, I would like to pick them up right now or later during the coffee break.
Thank you, Nikita. Certainly very useful information, and when we have our break as well and lunch, feel free to grab Nikita and have a good conversation and some interesting information. Our second speaking update is about UAE corporate tax law. I would now like to invite Mr. Mohammed Al-Swefi, partner at Ernst & Young. Mohammed is a partner in business tax services at Ernst & Young MENA, and he brings 23 years of experience in industry and professional firms. He is specialized in corporate tax and international tax, and an expert in corporate restructuring and internal reorganizations. Mohammed, over to you.
Thank you. Thank you very much. Thank you very much, and welcome and good morning, everyone. Really pleased to be with you today, and I can see, the number of people who are really interested in this very interesting topic, which I hope that actually, I will be able to, as much as I can to explain, what is coming up from the corporate tax and help in making it very simple to you. Before moving on to what I have prepared for today's session, just to, take a few steps back before the introduction and the reasons for introducing the corporate tax. Maybe a few years ago, we heard about, the BIPs and actually, base erosion and profit shifting initiatives, which is being created by the OECD, and harmful tax practices. And the UAE has been included in a gray list due to, the substance requirements which hasn't been met, and actually the harmful tax practices. These are all, alarming kind of areas which actually keep the UAE think about how to improve the environment and actually the tax environment for the UAE. Of course, VAT was introduced, but again, VAT is nothing to do with corporate tax, and definitely it's a totally different kind of tax. And over the time, there was always a need to think about, having the UAE to have a natural kind of tax environment, a neutral tax environment, which is going to help the business to see UAE as a stable place to do business. And we have seen as well that OECD has also introduced the BIPS Pillar 2, which means that there will be a global minimum tax rate which has to be applied for multinationals. So what does that mean? It means that for multinationals, they are going to pay an effective or minimum tax rate of 15% in whatever jurisdiction that they are operating, which means that actually if UAE did not introduce the corporate tax, it means that the multinationals who are in the UAE are going to pay 15% in the UAE revenues which are being generated. So if UAE did not introduce the corporate tax, then the tax on the revenues here are going to pay it somewhere else. So this is one of the key reasons for why introducing the corporate tax. In today's session, I will be very keen to touch base with you on some key elements that definitely we need to figure out and understand in the UAE corporate tax law. So as a key highlights in the law, it was comprised of 20 chapters, 70 articles, and 22 elections or applications that can be done as part of the law. And I will come to this point in a second. And also 30 open points subject to further cabinet decisions. We are not talking here about executive regulations, so there wouldn't be an executive regulation which actually covers all the pending areas in the law. It will be through cabinet decisions. Cabinet decision means, one cabinet decision follow the other, clarifying each single part in the law which has been referred to a certain ministerial or cabinet decision. The law has been also supplemented with 158 FAQs. The purpose of this is just to provide a level of clarity. It is not legally binding, but definitely it's a level of clarity through examples and through various clarifications just for the taxpayers to understand what does that mean, the provisions of the law and what does that mean. Back to the elections and applications, there is a difference between an election and an application. So an election means it is the decision of a taxpayer to go to that way or that way, to go with this option or that option. So it is for the taxpayer to elect whether I need to proceed, for example, on the realization of gains and losses or actually account for gains and losses on a realization basis, for example, or actually I will need to go with the unrealized option provided in the law. An application means I have to draft an application, send it to the tax authority, get the approval, and then move on. If it's being approved, then I will be able only to proceed. If not approved, of course, I cannot do anything with it. So who's subject to corporate tax? So mainly these are the 4 key areas when it comes to who is subject to corporate tax, and starting with the first one, which is the legal persons. So resident person and non-resident person. So resident person means any UAE incorporated entity or any foreign incorporated entity which is being managed, effectively managed and controlled out of the UAE. And the term of effective management and control is very, very important because actually it may touch on certain structures here where, it's a holding company which is being established or incorporated somewhere else in Europe, Cayman, wherever. However, board meetings, operations are being done out of here. So this means that actually, the tax residence is going to be in the UAE and it will be subject to tax in the UAE, not outside. So this is very important kind of concept that actually we have to consider. Non-resident persons means that, a foreign person who is having, a PE or a branch or an office, and also a non-resident person or a foreign person who is generating a UAE sourced income. So anything which is sourced from the UAE, and I will come to this point in another slide, will be subject to corporate tax in the UAE. For natural persons, and actually this is, will touch all of us because actually, natural persons means individuals. And the key thing is, everyone will think about, would that be, are we going to be taxed on our salaries, wages, these kind of stuff or not? So the answer is currently no. So there is no personal income tax currently being imposed. However, what has been mentioned is individuals who are doing business or business activity. And what does that mean from an individual who is doing business or business activity? It's not yet defined. It is one of the areas which will be clarified as part of the future cabinet decisions, which is going to be issued at some point. But as an indication, from the previous consultation document and other kind of discussion, it is very likely that a person who's a freelancer, a person who is being registered or actually doing an activity which has to be registered with one of the regulatory bodies in the UAE, then it could be constitute a business or business activity which need to be subject to corporate tax. For permanent establishments, and this could be a risky point because currently, and the way that actually most of the businesses are operating, so, and especially for, groups who will have, group entities outside, they have certain operations here. So you will find that, the law has introduced the concept of permanent establishment, which it's very typical to the, the international tax concept and definition of a permanent establishment, which constitute of fixed place of business or dependent agent PE. And the UAE has also included one point, which is any other form of nexus, which is, a forward-looking kind of definition, and I will explain why. For the fixed a fixed place of business, PE, or permanent establishment, is definitely where there is a, it's typical for all the branches which are here. But also typical for example, if there's a subsidiary here and the global, or actually, one of the head offices, they are using this subsidiary in order to perform certain activities on behalf of the global firm. So this may create a taxable presence for the global firm. Dependent agent PE as well is very, very important, because in certain cases you will find that a head office or a global firm is using certain supplier or an agent in order to conclude and negotiate contracts on their behalf. This is going to bring taxable presence for the non-resident in the UAE. So we need to be very, very careful in reviewing our contracts and the way and actually how we manage our operations. It's very important. And actually what we have seen with many clients, that currently in absence of tax, everything was very open, was very freely being done. So definitely, again, there will be a huge work stream to review the business model and how we operate. For the nexus, and as we may have seen or heard before, the digital economy and the challenges of a digital economy. So again, it could be this nexus definition may refer to pillar 1 and the taxing the digital economy, and whether at a certain point of time it will be one of the areas that the UAE will be considering for the future, so that they can tax digital economy and technological practices. Free zone persons, and we are going to dig more into this because definitely we know that actually this is very tricky, but again, as part of the resident person definition, this includes also a free zone person. So a free zone person will be subject to corporate tax, regardless of actually what we are going to discuss in the next slide in terms of a qualifying free zone person, which actually, the person or the qualifying free zone person that, fulfill the conditions to be a qualifying free zone person, and therefore will be subject to tax, but at 0%. We are not talking about exemption, but subject to corporate tax at 0%. So who is not effectively subject to corporate tax? And also I will start with qualifying free zone person. So given the sensitivity of free zones, and as we know, we have huge number of free zones in the UAE, and I guess each single company will have a branch or an entity in a free zone. So what does that mean to us? So the law has, and even the commitment from Ministry of Finance before, that actually they are going to honor the exemption granted to the free zones. However, what has been mentioned, that there will be certain conditions that need to be fulfilled. And these conditions, if it's not going, it hasn't been fulfilled, then whatever income generated, it will be considered as non-qualifying income. And what does that mean? Are we going to expose the entire income to 9%? Or we are going to split between the qualifying income and non-qualifying income? The earlier understanding, at the time of the consultation document, which many of you had visibility on, that if you are generating any non-qualifying income for within the free zone, then your entire income will be subject to 9%. However, with the law, there is an indication that a qualifying free zone may generate a qualifying income which will be subject to 0%, and non-qualifying income which will be subject to 9%. So the law now provides that you may have different sources of income, and these different sources of income, you will be subject to different rates. But of course, we are going to come to the complexity of this as part of the future slides. So the conditions that actually need to be met in order to be considered as a qualifying free zone and will be subject to 0% is first to earn qualifying income. And what is a qualifying income? This is, again, one of the areas that has not been clarified yet. It will be part of the upcoming cabinet decisions. But if we go back to the consultation document that actually was issued, it is fair to say that at a minimum, we can say that the qualifying income may constitute income generated from a free zone, and income generated from outside the UAE, and passive income. So passive income, which is, constitute dividends, interest, these are considered passive income, and if it is being generated by a qualifying free zone, then it will be considered as still, fulfilling the qualifying income definition. And maintaining adequate substance, and this could be a reference to the economic substance regulations, and many of the free zone entities should continue to fulfill the economic substance reporting. And of course, as part of this, the qualifying free zone person hasn't elected to be subject to corporate tax, because again, as a qualifying free zone, you will have the option to elect whether to continue as a qualifying free zone or to be taxable at 9%. So again, it is one of the elections which, will be subject. And again, it is really in the hands of the taxpayer himself, because once you do your analysis, you may feel that, no, I don't want to be subject to 0%, because, for example, I will be generating certain losses. So if I am subject to tax, then I will be able to transfer the losses to my other taxable entities. So effectively, maybe if we work out the numbers, it might be more efficient from tax perspective. So again, there will be certain situations where you may elect to be subject to corporate tax. And there will be, of course, complying with the transfer pricing requirements. This is a key condition. And it will indicate one thing, that potentially, if you have a free zone entity, and if you have another entities in the mainland, and you are transacting between the two, then it's very likely, as long as you are complying, you have a transfer pricing arrangement, so your deals and transactions with your mainland is at arm's length, and you are providing for the documentation, then the income that you are generating from these transactions with the mainland will be also considered as part of the qualifying income. So again, this option, or actually this condition, suggests that actually, again, the transactions with related parties in the mainland can be considered as part of the qualifying income. But again, I will really caveat my comments on this, but until we definitely see the cabinet decisions. For the exemptions, these are targeted exemptions. So the law came up with some key targeted exemptions. Targeted means there are certain conditions that, if fulfilled, so this list of entities and businesses will be exempt from corporate tax. However, there is one thing, that in certain cases, the exemption will be automatically given. For example, for the federal, Emirate government entities, these are automatic exemption. As long as you are fulfilling the conditions there, you are exempt. It doesn't require any application to be provided. It doesn't require anything else. However, certain kind of entities, like, for example, the qualifying public entity, public benefit entity, it requires the entity to be listed in a cabinet decision. So if the entity is listed in a cabinet decision that says that actually this entity is a qualifying public benefit entity, then they can, enjoy the exemption from corporate tax. And the same thing for qualifying investment fund, for example. So the qualifying investment fund, it requires an application to be submitted to the tax authority in order to to avail the exemption. So if the conditions are met, and definitely in Ruby conditions in in the law. Like, for example, the investments need to be listed, the fund itself is being overseen by the relevant authorities in the UAE. So if the conditions are all being fulfilled, then you can apply for the exemption, and you will get the exemption. Partnerships and family foundation. So for the unincorporated partnerships, it's going to be, treated as a transparent entity. So actually, the taxability will be in the hands of the partners, not as an entity. However, the unincorporated partnerships, they can, elect, or they can send an application to be subject as an entity itself. So they will say that actually, no, we wanted the partnership itself to be treated as an entity subject to corporate tax, and one of the partners will be the person who is responsible before the tax authority to comply with the requirements of the law. So again, the law has provided a level of flexibility for the unincorporated partnerships. Family foundation as well. It is the default position is to be taxable. However, if an application is being done to be taxable in the same way as the unincorporated partnership, again, the law has provided flexibility in this. Small businesses, again, there will be a certain threshold that actually, if a revenue threshold that actually, if met, then the entity will remain to be taxable, but actually that income is not going to be, subject to corporate tax. So again, further clarification on the revenue threshold is yet to be announced, but this is really to encourage the small businesses. What is subject to corporate tax? And here we are talking about, what is our starting point when we talk about, how much we are going to pay tax? And our starting point will be the accounting net profit. And our accounting, the accounting standards, which is being recognized in the UAE, should be our starting point. So we have to prepare our financial statements based on the recognized accounting principles in the UAE. So starting with the net profit and make whatever adjustments, and we are going to touch base on certain adjustments which came as part of the law in a minute. But just touching base on the UAE sourced income, which I have referred to it earlier. So this is any income which is being derived from a resident person or a UEPE. So when we discussed the UAE sourced income, which was part of the how the non-resident person will be subject to corporate tax, we mentioned that if they derive a UAE sourced income, and this is what we mean by UAE sourced income, so any income which is being derived by a resident person or a UAPE, or any activities that the non-resident person is performing in the UAE, which also includes the assets located or capital invested in the UAE. But there is a very important thing that the law has mentioned, that currently, this is normally should be subject to withholding tax, but the withholding tax is currently set at 0%. There would be some elements or certain categories of income which will be, payable to non-residents, which might be subject to different tax rates. But the law and the way that actually the law itself has been set is being set as 0% currently, and it has been left to cabinet decisions in order to make flexibility potentially in the future to change the rates of withholding tax at any category of income in the future. So making it very, very flexible for the future changes. Okay, so the second is the treatment of unrealized gain and losses. And it is also one of the very important things that, for unrealized gain and losses, it's part of your adjustments. So you have to, as long as you are, preparing your financial statements based on the accrual method, then you have to account for the unrealized gain and losses. And it means that actually you need to see what is there in your other comprehensive income statement. Because normally, or actually in most of the cases, your unrealized gain and losses is part of this. So you will need to bring your unrealized gain and losses from the other comprehensive income statement into your taxable income. However, we have to see how will be the impact on your effective tax rate if you are going to go with what the rule is saying by bringing the unrecognized gains and losses. And if we feel that actually it will be better to elect to be accounting for the gains and losses on a realization basis, then we can make an election. So the law has provided for an election to be accounting for the gains and losses based on a realization basis. So we need to do the math, and we need to see the impact on the business and the impact on your effective tax rate once we do the various scenarios. Tax losses is a very important one. So actually there is no restriction to carry forward tax losses. So you can carry forward tax losses indefinitely. However, you can only offset 75% of the losses for the next year. So you need to carry forward 75 and offset against 75, whatever is still in excess or actually hasn't been utilized yet. Then you can carry forward it for indefinitely, until you fully utilize it. Entertainment expense. So the law mentioned that entertainment expense will be disallowed at 50% if this entertainment expense is related to clients and your customers, entertaining your customers. So I think we need to be careful for these kind of events in the future. So definitely, it's definitely 50% when it comes to customer events, which includes meals, transportation, and so on. But the law didn't mention the employees, so entertainment to employees. So it is not part of the law, which may indicate as well that actually, for whatever entertainment that actually the company is doing for their employees, it could be an allowable in full. The non-deductible expenditure. So any expenditure not incurred for the purpose of the business, it will be not allowed. So definitely, it must be related to the business in order to get a deduction. If it is not, definitely you cannot deduct it. And of course, any expenditure derived for the exempt income, any donations made to other entities which are not part of a public, qualifying public benefit entity, again, this wouldn't be, deductible. And of course, nothing, even, definitely we shouldn't say that, but definitely, fines, penalties. But again, we are talking here about fines when it comes to corporate tax or actually any tax law related fines. But for example, the contractual, if you are in a contract and there is a fine due to delay in payment and whatever, then this can be considered as a deductible expense. So here, the intention is actually anything related to taxes or regulatory fines which you have incurred. So what other adjustments which has not been mentioned in the law? So what about bad debts? So bad debts is one of the areas that has not been mentioned in the law. What about the treatment of provisions? Again, this is one of the things that has not been mentioned in the law. So expectation that as part of the future cabinet decisions, there will be certain clarity as to what will be the treatment of these kind of items. Okay, so as part of the main adjustments as well, so we are talking here about the exemption of dividends and participation exemption. So domestic dividends will be exempt from corporate tax. So definitely you start with your net profit, and as part of the net profit, again, it will be part of, your dividend, whatever dividend received from, domestic participation or domestic ownership, you are going to deduct it from your taxable income. Foreign dividends and capital gains. So if you have a participation outside the UAE, and this participation is not less than 5%, so you own 5% or more in any foreign company, and this foreign company is also subject to corporate tax at a rate not less than the UAE corporate tax rate, which is 9%, then you will be able to exempt, or actually this dividend that you are receiving for this participation will be exempt from corporate tax. In the same thing, any capital gains received, if you are selling these shares, if you are selling, this stake, of course, it will be also exempt from the UAE corporate tax. Foreign PE exemption. So if the company has a foreign PE means a foreign branch outside. Of course, as part of your consolidated financial statement, that branch will be part of your accounts, and it will be subject to corporate tax here in the UAE. But at the same time, you will also get a credit of the taxes being paid outside, where that branch is located. However, there is one thing that also you can consider, that you can exempt this branch along with the taxes or all the related revenue and expenses of that branch, provided that that branch is also subject to corporate tax of 9% or more where that branch is located. So the law has also provided for the foreign PE exemption. So you can carve out the revenue and expenses of the branch. Aircraft and shipping of international transportation. So this is very common across many of the tax laws, and also included in the double tax treaties. And the main thing of it is, if a non-resident is generating, income out of this, so the law is providing that, the income will be exempt from corporate tax. However, there should be a reciprocal treatment in the country where the non-resident is based. So it means that actually, reciprocity treatment should be fulfilled in order to enjoy the exemption in the UAE. Group matters, which is a very important topic when it comes to forming a tax group and enjoying the whatever benefits provided in the law by having a tax group. But there are certain conditions that, again, need to be met. So in forming a tax group, there should be an entity in the UAE which owns 95% of the shares of the other entities in the UAE. And meaning that owning 95%, meaning that 95% of share capital, voting rights, and entitlement to profits and benefits. So if this is the case, then that main entity, along with the other subsidiaries, can form a tax group. And of course, the parent entity will act as the main entity to file the corporate tax return and so on. And the entire tax group will be treated as one single taxable person. There is one thing that actually, it's a downside of this kind of treatment, that there are two things. The downside of it is actually you are going to only enjoy the 0% or the first threshold of 375 on the whole tax group, not on each individual. As we all know, the tax rate is 9% for whatever taxable income above 375,000 dirhams. But this 375 is being accounted for each tax person. So if we are talking about a tax group which includes 5 taxable entities, so it will be counted as one. However, if each individual entity is filing a tax return, then each individual entity can consider the 375 0% threshold. But again, as part of the benefits of this, and as we are discussing here in the transfer pricing part, so any related party transactions within the tax group will be eliminated. So there is no need for considering the transfer pricing between transactions between the related parties within a tax group, which is, of course, a very good benefit. So what if we don't have a tax group? We are not able to form a tax group. So the law has also provided for transferring of tax losses. And what does that mean? So if there are two entities and each of them having an ownership of 75%, or at least the two of them are being owned by a third entity, which owns them by 75%, then they will be able to transfer the losses between each other. So one is profit-making, another one is loss-making. So the loss-making can transfer its losses to the taxable one, and effectively, this will improve the effective tax rate. Group transfers and business restructuring, which I think is very important kind of relief which has been provided in the law. However, again, certain conditions need to be met for fulfilling 75% ownership within the entities involved. So any transfer of business between the qualifying group entities, so definitely this will be, not subject. It wouldn't be subject to tax. So there is no gain, there is no losses in these transactions. However, there is a clawback clause. So if within 2 years there will be further transfer to a third party or to another party outside the qualifying group entities, then there will be a clawback, meaning that actually the original transaction will be taxable, and you are going to pay, taxes on the original transfer which has happened. Transfer pricing requirements. So the law has provided for transfer pricing regulations, which I think it's pretty much in line with different entities, different countries, in the Middle East. So definition of related party, connected parties has been provided, and the law has mentioned that related party transactions need to be all at arm's length. We are talking about related party transactions, either domestic transactions between domestic entities or between a local entity with a foreign related party. So there is no carve out of any kind of related party transactions in the UAE law. The 5 key methods of transfer pricing has been introduced, and definitely it's based on the nature of the services being provided. So you will need to make the right selection of the transfer pricing methodology that actually you need to use. The law has also provided to APA, which is advanced ruling practices. So definitely you will need to provide, or actually, if you are in doubt of any transaction that actually you wanted to apply transfer pricing, or whatever transfer pricing methodology that you wanted to apply, you can apply, or you can check with the tax authority and get an advanced ruling on that. Transitional provisions are very key. So we are saying that the law will be implemented for any financial year starting from 1st of June 23. So meaning that actually if your first financial year is starting in 1st of January 2024, then this will be your first taxable period. Transition rule is saying that your closing balances should be your opening balances for the first tax year, and it needs to be at arm's length. So from 23, you need to look at all your related party transactions, and you have to consider these balances if they are arm's length or not, and you have to do the homework from now. So it is not something that actually you have to wait until the law is being implemented, because this is part of your transition rules. The related parties and the connected parties, I think the law has provided for a connected party definition, and this is because of the absence of personal income tax, and this is mainly talks about the individuals, directors, and owners of corporates who will be having certain payments, or they receive certain payments from their companies, and they are mentioned to be a connected party. So whatever transactions and whatever payment given to a director or an owner of a company, it has to be at arm's length, and it will be under the focus of the tax authority. So this is just the, again, the journey of tax compliance, and I think this is the last slide of our discussion today, or in this session. So again, as we mentioned, we are going to start, or this is the effective the effective date of the law, 1st of June 23, assuming that 1st of January 24 is the first taxable period, then from that date, you will need to consider that actually any transaction will fall under the law. The date of registration, it will be open definitely at a certain point of time and expected during the coming period. Now, the FTA has started to select certain taxpayers, and actually now the registration is by invitation. But at a certain point of time, it will be open for everyone to register. There is no fines expected for late registration. Registration will be open until your date of your tax return. And I'm coming to this. So your first tax year, 1st of January 24, for example, you will, until the 31st of December, you will need to file your tax return after 9 months of the end of your financial year. So it means that 30th of September, you will need to file the master file, local file, for transfer pricing, considerations, and this need to be filed within 30 days after the request of the FTA, if required. And of course, maintaining documentation which need to be valid and actually available with you for 7 years. This is something that definitely you will need to consider. So this is just in a nutshell the end of our slide for corporate tax, and of course, I will be here around, for this morning and until we close, and will be welcoming any kind of questions or any comments from your side. Thank you very much.
Very comprehensive, very insightful, and I'm sure, like when VAT was implemented, there'll be lots of questions for you in the break, in the lunch as well. Welcome back, everyone. I hope you had a nice break, coffee, tea. We'll now move on to our panel discussion, and the topic is corporate tax implications on UAE businesses, where we will discuss and explore the implications for businesses ahead of sweeping reforms to the country's tax regime. I'd like to invite Mr. James Faulkner, Director of the London Stock Exchange Group, who will be moderating this panel. James has successfully managed to work with an impressive portfolio of industries ranging from governments, financial institutions, corporates, entertainment, and sporting firms. Thanks, James.
Thank you.
I would also like to invite on stage our esteemed panelists. Ben Phillips, Senior Tax Associate at Baker McKenzie. Brian Martin Mulholland, Chief Financial Officer of National Bank of Fujairah. And Mohammed, if you're able to join us back on stage, partner from Ernst & Young.
Yeah, sure.
James, I'll hand over to you.
Thank you. Thank you very much. Hello, everyone, and thank you so much for joining. It's a pleasure to be here. I must say I've moderated a few sessions already in 2023, but by far the turnout here at the moment has been the best. So if there was a competition, then you guys have won. So congratulations, the turnout is fantastic. So thank you, National Bank of Fujairah, for arranging a really, really good session and a very interesting topic. And also thank you to every single one of you for actually making this a possibility. Before I get started with our esteemed panel of guests, instead of me doing the introductions, I'd like to offer you that opportunity to give your profile. Starting to my right, Mr. Brian, if you don't mind.
Okay, good afternoon, everyone. Okay, still good morning, isn't it? I'm getting ahead of myself. Good morning, everyone. My name is Brian. I'm the current CFO of National Bank of Fujairah. Prior to joining this fantastic organisation, I set up a bank in the UK, a brand new challenger bank, seems to be the craze over there at the minute. And prior to that, I was finance director of Coots and global head of various roles within the Royal Bank of Scotland group as well. I'm very pleased to be here this morning.
Thank you. Ben?
Thanks, Brian. So, hi all. Ben Phillips, Senior Associate working at the Baker McKenzie law firm, focusing on all things direct tax and international tax related. So obviously the UAE corporate income tax framework is of particular importance to businesses these days. So very pleased to be here today and looking forward to hopefully answering any questions that you have as time goes by.
Thank you, Ben. Mr. Mohammed?
Hi, good morning, everyone. Good morning again, and sorry if I'm bothering you again with my presence on the stage. So my name is Mohammed Swayfi. I'm a partner at EY. I have been with the firm for 9 months now, and before that I was with another Big Four in Saudi Arabia, leading the tax practice for Jeddah. And before that, and for a long time period, almost 21 years, I was the head of tax in HSBC Egypt, for almost 10 years and another 11 years as regional head of tax. I was part of the the global tax board for HSBC group. So very happy to be with you again this morning, and looking forward for the interesting kind of questions.
Thank you very much, Mr. Mohammed. So let's get cracking. Corporate tax implications on UAE businesses. And before we start, just to make it very clear, we have the CFO here and we have tax experts on the accounting side, Mr. Mohammed, and on the legal side, we have Ben, just to make that differentiate. Starting off with Mr. Mohammed, so UAE corporate tax. Tell me about the change. How is this going to change the way that UAE businesses operate?
Yeah, I think this is very important, and definitely the move from an environment where there is no tax to a taxable environment. I think it will entail a lot of transformation potentially for the business, and definitely it varies. The transformation itself it varies based on the how big the organization is. So definitely for small businesses, it may not be that material, but definitely the materiality is going to increase once the size of the organization eats businesses. If there is a huge related party transactions, for example, or dealings with different suppliers inside, outside, then this is going to be considered. Also the fact of how we are being established and how we are operating in the UAE. And before that, many of the organizations were really free to work, within the mainland or free zone outside or within the UAE freely. There is no tax reporting, there is no any obligation. But now with the corporate tax, I think everything needs to be really reviewed, analyzed, see whatever gaps that we have now, what is really important to rectify. And definitely, doing this is going to take, some time. So definitely, the earlier the better, really, to consider whatever it change. But definitely, considering all what we have discussed in the previous session, I think transfer pricing will be a very important element, which is, which related to, the group entity transactions and related party transactions, and how we interact with that. Documentation is very, very important. And how we are classifying our expenses and revenues. This is also very important. The same thing as well when it comes to the technology that we are using and whether our technology is really giving us the right information that we will need. This is also something that actually we need to consider. So I hope, this is actually, my view regarding how it's going to impact the operations, I guess.
Very interesting, yeah. I'm going to touch base on the technology question later on as well, actually. But to Brian, talk to me about the challenges that UAE businesses are going to be facing, and also what do NBF suggest that their customers ensure to make sure that they are going to be compliant?
Yeah, so thank you for that. In terms of the challenges, I think the first one, and it's why we're all here, is you need to get the right information. And hopefully today will be either the start of that information or at least a continuation of that for everyone. And then the second big challenge really is, and what does it mean for me? How does it apply to me? And I think that's the key part of it really, because when you first go through a change and you're uncertain of the elements that are changing, it's really important to start the conversations as early as possible with, well, what's my business doing now? What do I want it to do? Because across everything, we can't forget that we're here in business to continue the business we've already been doing. So whilst corporation tax is coming along and we need to make adjustments for it, you can't forget about your core business and what it is that has made everyone successful that's in this room now. So that's the second aspect. It's about how does it fit for you. And then the third aspect is when it comes into application, have I actually been able to collect the right information? And have I stored it? And can I put it into the right returns? And can I make payments on time? So it starts with a conversation here and now and continuing. It then is about how does it fit for my business, which really is about understanding your business and what the elements would be in terms of taxation. And then how do I run it thereafter? So I think those are the three main challenges. And I think sometimes we get really caught up with, we saw lots of information on the slides, really helpful to start thought processes, but I think we can get really caught up in that and start to worry about it. Whereas actually, if you have the right conversations with the right people, and I'm not here to plug tax advisors, but I think when you go through massive amounts of change, it's probably helpful. I think you can get caught up in that, whereas you've got to also think about how do we run it on an ongoing basis.
Yeah, well said. Bringing yourself in, Ben, let's talk about mergers and acquisitions domestically. So UAE corporate tax, how does that impact domestic M&A?
Yeah, so I guess historically the environment for the UAE has been quite, let's say, simple when it comes to mergers and acquisitions. There's not necessarily been a historical need to do a tax due diligence. Obviously, with the recent introduction of VAT from 2018, that is the only tax that people have really needed to think about. But the UAE corporate income tax will change that. There will be a need now for, let's say, not for the next few years at least, but certainly going forward, tax due diligence is to be done from a corporate tax perspective. That will obviously expose, let's say, hopefully not many, but potentially historical risks there that would need to be factored into a deal that is to be done. But kind of putting that to one side, it also means that the UAE now effectively you have to take into account tax on your investment returns. So what previously may have been easy to obtain, you've now got 9% of that return being taken from a tax perspective. That might have an impact on, say, competitiveness. Hopefully not in the region, because the rate that the UAE has put forward is in line with, let's say, or the lowest in line with the region, with Qatar being the next at 10. So it will be something that needs to be factored into, let's say, financial modelling and what those returns look like, but hopefully shouldn't harm overall competitiveness of the landscape. But we'll also start seeing that then feed through into transaction documentation as well. So be that in your SPA, there will need to be reps and warranties in respect of corporate tax positions that have been taken, the governance that's been applied, and is that a business that an investor wants to invest into? Are there those policies and procedures that give an investor comfort that tax is being managed in the right way? Whereas historically that has not necessarily been a concern. And that then also feeds into what investment structure do you use? We typically see UAE SPVs because there is no tax. They're easy to establish, and there's no requirements that really go along with that. That's obviously changing with corporate income tax being introduced. There's now a greater level of transparency being introduced into the country. Hopefully that doesn't dissuade investment, but it's certainly now considerations that need to be thought about, because there will be information that's going to be made public, or at least being disclosed to a body outside of a business that historically hasn't needed to, because there hasn't been a requirement for audited financial statements or submissions to be made. But obviously that will now change going forward.
Mm-hmm. Yes, very interesting. Mr. Mohammed, moving on to yourself, you gave a really good presentation earlier. There were some numbers there, 20 chapters, 70 articles. for the audience, explain what are the key definitions within this law, please?
Yeah, I think I would say that definitely there are some key definitions which has been provided, although there will be further interpretation to these definitions as part of the cabinet decisions. And some of the key definitions haven't been already provided in the law at all. So, for example, something like a nexus. I think we highlighted this in the previous session, and it was repeated in Article 11, 12, and 14. And again, it means that actually there is a level of emphasis on it, but actually we don't know. It hasn't been defined in the law yet. So this is something that, again, we need to look at, how, from an international tax perspective, what was a nexus means, and actually what did the indication from a, Ministry of Finance for any future, and given the nature of businesses here, and the future looking of the international, implications from tax perspective. So definitely this could be one of the areas that actually, again, we will need to see further clarity on. Another thing, when we talk about the qualifying income, and we explained this in more detail in the session, and actually qualifying income is one of the things that it is part of the conditions for a qualifying free zone. However, nothing has been mentioned in terms of what constitutes a qualifying income. So we will try really to provide certain assumptions which will be relevant to a free zone and its mandated kind of operations. So definitely any free zone is mainly required to deal with, within the free zone, and definitely with outside the country. And that's why, it will be really required to link what a qualifying income with the permitted activity of a free zone entity. In order also to ensure that actually the Ministry of Finance ensure that actually the economy and actually the investors in the free zone still, in line with what the country has promised to give in terms of protection for the coming maybe 25, 50 years from a corporate tax perspective. Other things like, permanent establishments, which, for certain taxpayers who don't have, previous tax experience. So permanent establishment is one of the key risks that we have seen in many jurisdictions. Given the operations and the way that companies will operate, it is very important to understand whether their global business may create a permanent establishment in the UAE or not. So again, understanding what a permanent establishment means is very important. And we clarified the various types of permanent establishment, which is a fixed place of business or dependent agent permanent establishment. So again, I think these are one of, few examples of key definitions in the law, which I think is very important to be considered. And we are looking forward to see more in terms of the details and explanation as part of the upcoming cabinet decisions, for sure.
Thank you, thank you. Very, very detailed. And of course, don't forget that once the session is over, I do urge everybody to pick the brains of our experts here, because obviously there's so much information in such a short period of time. Brian, so in your experience, talk to me about allocation of resources. If I'm a business owner, how do I allocate my resources correctly just to make sure that I am compliant?
Yeah, so there's two broad approaches. One is you can go out and try and hire an in-house team. I think what you'll find in this marketplace, because it's such a wide-ranging implementation, that resource will be very hard to come by. But the good news is on the other side of it, there is a lot of tax advisory firms out there who are geared up to give the right advice. Now, my personal take on this, and this is what I've seen in the UK, as well as here when I look at how NBF in particular implemented the VAT piece, I think it's very important that you try and take out as much cost as you can. So when it comes to the collection and processing and storing of information, you do that from within, because it doesn't take a tax expert to do that. But when it comes to the setting up of how and what information you're going to collect and the right way of structuring your organization. And when it comes to the oversight at the end of the information and before your returns go in, I think those are the two key bits where it probably pays to have that little bit of advisory advice, but to keep the cost down, which we all look to do, certainly banks included, it's really worthwhile thinking about the way in which you collect and store the information. It was started to be touched on as well. There are technologies out there, and there are more technologies that are coming that actually link accounting software with the tax elements, and where that is possible and where it fits your business, that tends to also be a very cost-effective way of pulling it together.
Yeah, thank you. You're touching base on my technology question, which I'm saving to the end, but it's a very interesting topic. You spoke about structuring, so moving on to yourself, Ben, let's talk about restructuring. Let's talk about reorganization. So as a business owner, how does one optimize their tax efficiency considering this new tax regime?
Yeah, I think there's been a lot of change, obviously across the UAE in the last few years. So if we take obviously UAE corporate tax being the main one, at least from a tax advisor perspective, but there's been a lot of legal changes in the framework as well over the last few years, specifically around the allowance of 100% foreign ownership in the UAE. So whereas typically there may have been 51-49% ownership structures, we're seeing a lot of clients are looking to tidy that structure up, and the introduction of UAE corporate tax has certainly accelerated that. And it's essentially now is the best time to do those restructurings, because at the moment the only tax that is applicable is 5% VAT, which would only really apply if you're doing asset transfers rather than share reorganizations. So we're certainly seeing a lot of businesses review their structures. Do we have historical arrangements that we don't necessarily need to have anymore in light of the change in UAE legal landscape? And what does that then mean to our overall group structure? Mohammed obviously mentioned about there being group relief provisions and 95% shareholding requirements. Where we have these local shareholder requirements, we don't meet that group definition. So we're certainly seeing businesses look to restructure those reorganizations, clean up their group structures so that they can benefit from the tax provisions that allow for fiscal unity and consolidation, so that they become one taxpayer rather than multiple, to ease the administrative burden that's going to be imposed as a result of corporate income tax. As Brian mentioned, there's a limited resources, there's a limited amount of, let's say, budget going around for everyone to adopt these measures. Whatever businesses can do to ease that burden, we're certainly seeing they're doing that, and reorganizations is definitely one of those ways. And we're also seeing it through rationalization as well. Mm-hmm. I think historically, entities have been set up because, well, there was no need to consider anything more. You house an entity to hold an asset as a single SPV. There was no cost really that was associated with that. With there now being a tax filing that is associated with that and accounting requirements that go along with that, businesses are certainly looking at, do we really need that entity? Can we rationalize that? That will save us costs in the future. Mm. So we're certainly seeing a big cleanup happening on corporate structures.
Yeah, interesting. So talking about that big cleanup, Mohammed, let's talk about lessons learned. So VAT was introduced back in the UAE 2018. So are there any previous experiences, best practices that we could implement with this upcoming corporate tax?
Yeah, for sure. And definitely this is, reminds me with the time when I was in the industry as part of the, HSBC, as I mentioned before, that, the introduction of VAT was, from the beginning of 2018, as we all know, and definitely at that time, I had to start, a little bit earlier. So I started really in the middle of 2016. So I started to engage with advisors and start to, kick off the work with various work streams and various businesses within the bank long time before. But what I have realized that actually this is, really, if I started a little bit late, I wouldn't have reached the situation when I reached it at the time of the implementation. So although I had almost more than a year to prepare, but really that was, I wouldn't say enough, but definitely if it was a bit longer, it would have been better even. So we shouldn't undermine that actually this is maybe a law, and actually we talk about the simplicity of corporate tax and intention of the Ministry of Finance, which is really appreciated. But again, the impact on the business, we read a lot of understanding, and actually, everyone should do a lot of analysis with business, interaction with business people within the organization, with related parties, with suppliers potentially, going and see, whatever contracts that we have. It is very important to have a deep analysis and potentially maybe, getting a view from experts, getting, a lobby with other peers in the same industry, lobbying, don't miss any opportunity for Ministry of Finance awareness sessions, for example. So, always get an update regarding what is happening, and be aware of whatever clarification coming in from the cabinet decisions, which is expected to be issued from now until June. So, with that all in mind, and with the work which required to be done, so definitely, we shouldn't say that actually, let's wait until further clarity is out. No, definitely it wouldn't work with you, because even if your first account period is still in January, definitely you need, January is, it's around the corner. So definitely it will be coming soon, and definitely you will find yourself trying to, to understand what you should have understood long time ago. So I think better to be prepared well before is my advice, really.
Indeed, indeed, yeah. It's scary to say that January is just around the corner. We've just started the year, but it's right. You have to be prepared or prepared to fail, I guess.
Yeah, maybe one thing that actually, considering the point of restructuring, which is great point that you have highlighted, Ben. And I think, with a lot of arrangement, which actually most of the companies will need to do, we have also to consider that the law has introduced the GAR, the General Anti-Abuse Rules. So definitely we have to keep this in mind. So, making whatever restructuring or actually changing ownership, we have also to consider the business requirement and if there is a business need to do that. It shouldn't be only for tax purposes. You have to think about what other business, benefits which you will substantiate if you are being asked by the FTA at a certain point of time. So you have to consider the GAR. It shouldn't be only a tax-driven kind of exercise or arrangement. So you have to consider the various elements of the business as well, in order to do whatever arrangement.
Very insightful. Once again, I do urge the audience just to write down your questions, because we will shortly be having a Q&A. So please, please, please write your questions down, because we will have a Q&A. Brian, in your experience as a CFO, this new corporate tax regime, how does it change the way that NBF does business with its customers, and could other corporations or companies follow suit?
So in terms of us, the good news really is that it won't really change a lot in terms of how we deal and interact directly with our customers. When we look at it, we are still absolutely committed to being the financial partner for both you personally and you as a business. And really, on top of that, we're very, very committed to your success, which is obviously why we run these types of sessions here today. We've got a very relatively simple corporate structure. And that means there isn't a lot that we will do that's going to change, that will impact any of our customers. We deal all principally from the mainland. We do have entities in the free zones, but that's more operational aspect. So none of that will particularly change at all. What we will see internally is that in the same way that all of you will have to, we will be going through our structures, and we'll be trying to maximize, or optimize is probably the right word, the difference between our accounting profit and what becomes our taxable profit. So we'll be looking at how do we optimize, I'll use that word carefully, how do we optimize the income that we report? How do we optimize the expenses that we report from a tax perspective? Because we're no different. Fundamentally, we are a business like all the other businesses around here, and we're either business owners or business managers, and we've got that same mentality. But in terms of how we interact with the customers, I can categorically state there will be no change there. What you will get from us is, as we go through our learning as part of this process, and we've only just started, but we have started, we'll be willing to share that because this is an open community. This is about us trying to work together, cross-sharing information. Whilst I have talked about, from time to time, optimizing the tax advice, let's be honest, if I get a good bit of tax advice, I'm quite happy to give it for free. I'm not here to say, well, I paid for this tax advice, every single one of you has to pay for it as well. Where I can get good value from it, I would happily pass that on. I think this is where I have to do that caveat, though, that says anything I say to you is not proper tax advice. You can't sue me for it later. But I will give it in good faith, and I'll pass it on, which means that when you do use any of that information, you can get to the nub of the issue for your business with the tax advisor. So in a broad scale, nothing much is going to change, but where we can give you information, where we can pass it on and share, we absolutely will.
Yeah. Ben, if I'm a business owner, a key question that I'm going to be asking myself is, what are the biggest risks considering these new tax rules? So what advice could you give to the audience in terms of the biggest main risk that you foresee, especially internally as a business owner?
Yeah, I think maybe the theme of today has certainly been uncertainty. Right? There's a lot that is still uncertain, and I guess none of us like that. No one wants uncertainty. We want the information out there and to make decisions upon. And I think, as we've kind of just touched on during the course of today, right, we're probably at a stage now where it is, you definitely need to act. And even if that is on uncertain information, because we're getting quite close to, let's say, the January timeframe when businesses are probably likely to be subject to corporate income tax. And that's not a lot of time when you think about the business changes that need to be put through, and it's not just tax that needs to be okay with it, it's the business as a whole. So I think businesses are having to act now based on uncertain positions. What that can potentially lead to, and I think what we did see from the VAT being introduced is, does that then lead to disputes with the tax authority later down the line? Hopefully that's not such a prevalent issue, because the UAE corporate tax will require filing over, say, a 12-month period rather than VAT on a 1-month period, so you've got a bit more time to adjust your systems when that information does come out. But to the extent that people are acting on uncertain information, be that the definition of qualifying income if you're a free zone entity, which I think is probably the key question that I hear daily, where you are making those decisions, it's good to have, let's say, positions documented through advice from tax advisors, opinions taken, position papers released, discussing with the business, well, what is at risk here and what could I potentially be subject to in the future? The UAE Ministry of Finance recently revised the tax procedures law. That was somewhat beneficial in some of the changes that were put forward, where, at least from a VAT perspective, those regulations are going to equally apply to corporate income tax going forward. So the penalties and the regime is already there in existence to kind of catch where there are issues. So we just need to ensure that we're taking, let's say, advice where there are key risk issues, having that documented, having that trail to show the process that you've taken to get to the decision that you have, so that when you are challenged by the authority, you can say, well, this is the advice we've taken, this is what we've done, this is why we think this is the right position, and therefore our position, we think, stands. So those would be, I guess, some advice in that respect.
Thank you. Those are the risks covered, but Mohammed, moving on to yourself, let's talk about the framework. Let's talk about tax policy, tax governance. What impact is UAE corporate tax going to be having on those spheres?
Yeah, sure. I think it is a key trigger to consider. What are the governance that we are having now? So I think at the time of the introducing the VAT, it was the first tax many of the companies to deal with, and if you didn't establish a tax governance at that time, which includes what you are doing and how we are going to manage the risk of the indirect tax, or actually the VAT at that time. So now, with the corporate tax introduction, this is the time. So now you are going to deal with corporate tax, you're going to deal with the VAT. Corporate tax includes also transfer pricing, related party transactions, which you need also to manage. So you will find that actually you are dealing with number of tax risks. And as you have highlighted, management we need to know how we are managing our tax risk and what kind of reports that actually, the management team and the board need to know about tax. So if you don't have a governance in place, and the starting point of a governance is to have really a strategy. So you need to form a strategy on how your tax function is formed, what kind of advice or what kind of tax work that you are going to do in-house, when you have to go out and seek external advice from external advisor. What is your tax appetite in various kind of taxes, whether qualitative, quantitative tax appetite? You need to define that. What are your key tax risks and what are your key tax controls, which you need to establish? And the most important thing, what is your business or risk model, which you need to adopt in the firm? So when we are creating a tax governance for any of our clients, we need to align with the normal risk model which is being adopted in the firm itself. And we need to have a discussion with the head of operational risk and risk officer to understand what's being adopted so far. And we need to align with this, because as part of the tax governance, you are going to allocate responsibilities across all the firm. So for example, VAT as a type of tax, it is not only the responsibility of the tax function, it is the responsibility of everyone in the organization. So in allocating these responsibilities, you need to have a governance in place. You need to have a risk model to protect and define the role of everyone. So if you don't do that, then when something happened wrong, then you wouldn't know where is the defect is coming from. You wouldn't be able to trace what was the problem and where is the issue. If you don't have a governance and key controls and people who are performing these controls and other people who are doing a testing on these controls. So my really advice is actually tax governance is very important kind of area that actually has to go hand in hand with the implementation of corporate tax. You need to look at not just corporate tax but anything else named as tax that you are dealing with as part of your tax governance. You need to allocate responsibilities. You need to create some sort of reports which is going to govern how you report your risks to management and how you monitor your risks. For example, uncertain tax position report will be one of your key reports that you have to generate. It includes all the uncertainties that you will have, quantification, are we going to provide for it or not, and so on. Heat maps, quarterly tax packs, which actually normally I will presume that actually all the CFOs and all risk committees within your organizations potentially may need to see. So these kind of areas, I think it is very important to be considered along with the corporate tax implementation.
Thank you, Mohammed. My final question before opening it up to the audience, and it's the one I've been talking about, technology, so heat maps, reporting. How can we simplify this? So are there any solutions out there? Do you foresee something coming in the future? So that first question is going to be to everyone, but starting with yourself, Brian, since you're right next to me, question to you.
So I've not investigated in the UAE the different tax softwares, but I am very aware of tax softwares, or accounting softwares actually in the UK, that are now linking with tax softwares and they're direct plugins. So actually these days in the UK for nearly all SMEs, and then it's building up to sort of smaller corporates, are literally using straight downloads from bank accounts, which is obviously a good thing that from a bank's perspective, directly into accounting software, which is then plugged directly into the tax software. And the key to that is, whilst up front you have to define your transactions, once you've defined the transaction, what you're then left with is relatively a straight-through process, and it almost puts some of the emphasis on the provider of the software to actually keep up to date with the tax changes. Now, that doesn't give you a get out of jail. You are responsible for your own tax affairs, but it does simplify the straight-through process of it. So I can foresee that in the UAE, now that corporation tax has come in on top of VAT, I could definitely foresee quite a few software companies coming into the region and really trying to hit the ground running.
Yeah, they'll be licking their lips, attacking a new market, I suppose. Ben?
Yeah, and I think maybe just to follow on to that point, I think there are already a few service providers in the UAE that are providing that. I wouldn't say it's as developed as the UK market, and I don't think there's as much choice as the UK market, but there are certainly providers that are available. And maybe just to add on to the point you made there, Brian, so the software is great for automation. Once you've got it set up, year on year, it runs through. I guess the key for using software is you need to have that policy and procedure in place to capture where there are changes on a year-to-year basis, be that from your business or from the tax legislation. I think you can sometimes get into an over-reliance on the software provider, and that what they provide, you just assume everything is right and everything flows through. But if there isn't that level of communication to them about a change that has been made to a particular, say, a GL ledger that you've decided to treat differently this year to a previous year, they're not going to pick that up without that level of communication. So the policy and procedure in place and the ongoing communication with the service provider will be necessary. It's not just, we've got some software, it's all done, we don't need to worry about it.
Yeah.
It takes a lot of the admin off your plate, but it's not a complete overall solution.
Not the total package, understood. Last question, and to you, last but not least, Mohammed.
Yeah, sure. And, I wanted to add a lot from on what my colleagues has mentioned, but I think the key thing is we need to assess what we have. So in most of the cases, and from what we have seen with our clients, that actually they have a very good technology which actually has been already embedded at the time of the VAT. But there might be certain functions which haven't been activated. So rather than to reinvent the wheel with the corporate tax, we need to assess what kind of functionality that we have already in our systems. And definitely this will be in line with your advisor. They are going to assess what you have, what kind of information that you are that your system is able to provide you, and whether it will be potentially easier to activate the functions which you are not currently using, or actually it is not being activated yet. So it could be, this is the easier approach, and potentially it works for many of the taxpayers that actually they have already good system, rather than really to make a very big kind of investment again, which I think a lot of investments have been done at the time of the VAT. But at the same time, and as we are yet to see what will be the form of the tax return, which has not been announced yet by the tax authority, and whether this can be linked to your ERP system in order to collate and actually extract the data, this is yet to be to be given and to be announced at a certain point of time. But again, preparation or actually understanding your data is very important. Understanding what the system is currently providing you is extremely important. Retention of the data is very key, because actually you will be required to retain the data for 7 years. Again, whether your systems will be able to retain these data or not. So again, it is one of the areas that you need to assess. So
yeah. Retention of data is a key thing, and being a data provider, small little plug there, data is very important in this day and age. We have a CFO, a chief financial advisor, we have tax experts on the legal side, on the accounting side. It's time for the fabulous audience. If there are any questions, then please, a show of hands. I urge you to pick the brains of our experts, and I'm opening up to the general public. Lady at the front there, is that a hand up?
Good afternoon. So my question is built around tax group. So maybe Mohammed can answer. So basically, what we understand so far is that we need to have a holding company which is holding 95% of shares in various entities to form a tax group. So having said that, if you have entities which are rated differently, like at 0% and 9%, per se free zone companies and mainlands, will they be allowed to form a group?
No, the entities within a tax group should not be an exempt entity or a qualifying free zone entity.
Okay.
So all the entities within the tax group need to be resident entities, need to be taxable. So
has to be taxed at,
has to be taxable
at the
in order to be
unanimous
part
rate.
of the, yes.
Okay,
Yes.
and I have one more question. Can I go ahead?
Yeah, sure.
Please.
Yeah. Okay, the other question is regarding deductible expenses. So I'm around interest. So when we are saying interest and 30% will be allowed in a particular year as to the percentage of EBITDA, so we are looking at interest on business loan, mortgages, as well as leasings like vehicle loans. Will that also be included?
Are you part of a, is your company it's not a bank, of course, or insurance company, right?
No, it's
Yeah.
it's a SME into trading of.
So, very important thing to consider that the amount that we are considering is your net interest income.
Okay.
It is not the interest paid. So you have to
Okay.
consider, if you are also receiving interest, for example, on anything, and when you are also paying interest. So actually, the net of them is what you are considering.
Okay, so you have answered
So-
my other part of the question in advance. So the
Yeah.
other part was that if I'm earning some interest from related party, which meets the specific rules of
Should apply.
business interest and the arm's length transaction, then I'm allowed to deduct that income from my interest expense.
Yeah, for sure. If it is, but again, you need to you are receiving that income, right?
Right.
Yeah.
So it is the net interest that has to be taken as 30.
Yes.
Thank you so much.
Thank you.
Thanks.
But again for this one, of course, the arm's length rate need to be considered. So actually,
Right.
if it is a related party, so again, if you are even a receiver of that interest, again you have to consider that actually whatever interest that you have received is
is
arm's
as per
length.
the rules. Yes,
Yeah.
transfer pricing remains subjective right
Yeah.
now. Thank you.
Okay.
Thank you so much.
Thank you. Thank you very much. Gentleman at the back, I can see your hand raised there.
Hi, good afternoon. My question is regarding foreign tax credit. Now, countries like Qatar and Saudi have withholding tax in place. Now, when we talk about foreign tax credit, does it include the withholding tax deducted in transactions in dealings with KSA and Qatar, for example, where they deduct the withholding tax while making a payment to us?
So the foreign tax, that was withholding tax that has been deducted against
Right,
the payment
right,
from Saudi Arabia to
right,
you, right? So
right.
definitely yes. But you have to compare, for example, in Saudi Arabia, as we know, withholding tax rate may be more than 9%. So in certain categories of income, it could be 5%, could be
Right.
15, could be 20, right? So you will be able to get a credit, or actually of this foreign tax, which you have paid in Saudi Arabia, but it should not exceed 9%, which is the tax on the same income here in the UAE. So it has to be, it shouldn't exceed the 9% of the same income in the UAE. So if you are subject to withholding tax at 20% in Saudi Arabia, you will be able to get a credit up to 9%.
Okay. I have one more question regarding the foreign companies for which the control and management is done from UAE. Now, in those cases, what we are saying is that these will become taxable in UAE. Now, we have a lot of investments, private investments of the companies in, let's say, Cayman Islands, Mauritius and all. And this will be a big change overall if these were to become taxable. So, I mean, will these become taxable in principle, or I mean, what is expected out of the law from this?
Yeah, again, the nature of the business will need to be analyzed further. I'm not sure if it is it a family business, or this investment is for the purpose of family. So again, for family businesses, again, the law has provided for certain schemes which can help families not to be really exposed a lot to tax. But the key thing is actually we need to analyze the business further. But actually, if we are talking about foreign investments which are being there, and actually everything for that company which is being established outside the UAE is being managed out of here. So unfortunately, the business will be taxable here. But again, we have also to consider what kind of income that we are generating out of these investments, right? So, would that be in the form of, maybe dividends, in the form of, normal income, commission? I'm not sure, but definitely we need to dig more into the nature of the revenues and see whether the law has provided some sort of exemption to these revenues itself, to these kind of income. So it is another angle that actually we have to analyze.
Okay.
So it requires really, some sort of deep analysis of this.
Thanks.
Sorry, just before to go back to your first question, so around the use of foreign tax credits for withholding tax, another important point to check is there a treaty in place? And that's not necessarily from the reduced rate, it's more that you may not be able to claim a credit for withholding tax that you suffered where there isn't a double tax treaty in place. So, for example, the KSA has a treaty, Qatar doesn't. So you may end up in a situation where you could claim relief for KSA, but you may not for Qatar. So that's a point to check if you do have withholding tax leakage around the group.
So is the foreign tax credit also dependent on the tax treaty, or irrespective of the tax treaty, we will be able to claim the foreign tax credit?
So in some jurisdictions, and I think it isn't particularly clear in the UAE as to whether this will be a rule that is in force, but if there isn't a reciprocal arrangement in place so that you could claim the credit back in the other country, you aren't able to claim that relief in the claiming country, so in the UAE. So if there isn't a treaty, that withholding tax could just be a pure cost. It obviously wouldn't be reduced because there isn't a treaty, and the UAE would say, we're not going to give you any credit for it because we've not entered into a double tax treaty with that jurisdiction. Where you do have a treaty with that jurisdiction, they'll allow you to claim that credit because that's a requirement under the double tax treaty.
Okay, thanks.
Yeah, good afternoon. So my question to Mr. Mohammed, yeah, I'm here. So my question to you is, do you see, is there any cap going to be on the management remuneration which is allowed as allowable or disallowable? And the second part is, we all know that, to get more transparency and UAE being in the grey list, obviously it's a responsibility of all the business groups. But there will be a little discouragement to the business group when the corporate tax was announced and introduced.
Yeah, I think, again, we are looking for, or actually the UAE is looking for further transparency and definitely, having a taxable tax environment now, I think it will not harm the tax environment as a whole in the UAE compared to other jurisdictions, but because again, most of the other jurisdictions will be in the same, kind of environment soon. So again, we hear that actually Bahrain will be undertaking the same kind of steps like what UAE has taken. So, and you will find that definitely other, offshore jurisdictions like Cayman and others, in certain cases, it's not really helping the companies in their dealing with banks, and they're dealing with, financial institutions generally. So definitely they are going to struggle if they have complicated kind of structures. And this is part of really, the wider tax transparency kind of angle. So it's not, I wouldn't say discouraging. I think currently, the law is very competitive. The tax rate is very competitive. Free zones still enjoy, hopefully they will continue to enjoy the benefits. The UAE is not going to make it so complicated in terms of even if you are driving non-qualifying income. There will be just the point of internal documentation and internal potential attribution between what constitute qualifying income and non-qualifying income and whatever related expenditure related to each revenue stream. So it is an internal admin work which actually will be required to be done.
Yes, sir.
Just to add on to what Mohammed had said, there's a wording in the law that says connected persons include officers of the company. So could you comment on that? One is that. Second is regarding the transfer pricing. As you mentioned in your session, that the opening balance sheet should have the values at arm's length price. So, how is it? Could you just comment on that point also? Thank you.
Yeah, for the rules have expanded whatever key people who are connected with the business, which includes directors, officers, owners, and others. So officers could be people who are really on the top of the house, that actually they are making the key decisions. They are very well connected with the firm, and definitely they will have bigger interest into the operations of the firm, and that's why their remuneration, their payments, they shouldn't be extremely different from the normal kind of work which is being done in other organizations. And on the other part, regarding transfer pricing, methodology and transactions, we are talking about services which is taking place between related parties. If it is services or goods or transfer of goods and everything, it has to be in line with a third party prices. So again, transfer pricing deals with as if you are dealing with a related party as if he is a third party. So if you are a company and you have a sister company, so how much you are going to price your transaction if you are dealing with a third party that you have no relation with? Are you going to give that sister company the same prices for the services or goods that actually you are providing, or is it different? And that's why there should be a benchmarking study which need to be done for any related party transaction. And we have to consider the nature of that service and the transaction itself. And we have to go to the comparable, or similar transactions between third parties and see how much, prices has been set for these kind of transactions. And we will get this as a benchmark and apply particular rates or similar prices to the related party transactions.
So what happened if the transactions took place prior to the introduction of CT and those values remain in your balance sheet? So should those values be revalued? I think I misread it somewhere.
Yeah. I think it is very important, because the values or the balances of the related party transactions before the law, which, for example, if we are assuming that the first tax period is 1st of January 24, so the balances of your related party transactions will be your, the beginning balances of the new year. And this is part of the, transition rules, which means for you now that you have to look at your related party transactions and make sure that it is arm's length from now, because you need to close the year, having these balances at arm's length. So this is the intention of having these, documentation in place, prices to be done from now, in order to make sure that actually you are starting the year, with all your balances and transaction at arm's length.
Thank you.
Two hands, three hands, four hands, all these hands going up. The lady at the back, please. I'm afraid to say, are we okay on time at the moment? Because I know that I'm heavily over. I've got the thumbs up from the boss. 2 more minutes? Okay, yes. The lady at the back, you, sir, and then somebody in the corner. We need another session, don't we, guys? That's the thing. We need an extra, another NBF series. Yes, please.
Question to Mohammed. See, I just want to have some clarity on free zone company. In case we qualify as qualifying income, can we not register for CT?
No, in all cases, free zone entities are going to register for corporate tax. So, whether you are subject to 0% or 9%, you are driving qualifying income, non-qualifying income, you need to register for corporate tax, you need to file a tax return. So this is a given. And the key thing is why the Ministry of Finance has mentioned this, because again, it is your own judgment that actually, yes, you are saying that, you are driving a qualifying income, but who knows? Until you are being inspected by the tax authority, and tax authority will come and analyze your transactions, and give you the stamp that actually, yes, you are right. So that's why even although you will be assumed as subject to 9% if you are driving fully, qualifying income, but again, this is subject to further confirmation by the tax authority, and that's why you have to file a tax return.
Okay, thank you.
Gentleman at the front as well, please. I think the microphone will come shortly. Microphone for the front, please. And then there was somebody on the left. I haven't forgotten about you. Yes, sir. You'll be the last before we go for a break.
Hi, good afternoon. My question is for Mr. Mohammed. That what are the potential risks and challenges associated with the transfer pricing, and how to effectively manage it?
What are the risks of transfer pricing?
Potential risk and challenges.
So if you are not considering transfer pricing in your related party transactions, what's going to happen? So tax authority are going to look at all your transactions with related parties, and they are going to apply, markups potentially or certain adjustments to these transactions. For example, if you are providing certain, certain services, or actually you are getting the service from outside, and you are generating a particular revenue against your dealings with your related party. So tax authority can definitely assume and can tell you that actually you have understated your revenues. They can do whatever they want. You have understated your revenues, and your revenues need to be up by 20%. You will have the burden of proof to tell them that actually, no, I have done the benchmarking study, this is my documentation, this is my study, these are the benchmarking rates, and I have applied this markup. But if you didn't do that, it will be very difficult for you to challenge. And that's why this is the major risk, the ultimate risk of not doing whatever is required, and which will be subject to further adjustment by tax authority.
So it has to be any particular markup, or as per the peer industry, or something?
That's why actually, it requires analysis. The benchmarking study, we go back and they check the database that we have regarding various industries. Of course, we have to look at the similar industry that you are working in, similar kind of services. We have to first look at the region, or UAE first, MENA region. If we don't have comparables, then we can go to a wider one. Maybe we can go to Europe, which is a closer region to us, and then see what are the services which are being provided there, what are the prices, and then we are going to benchmark against it. So it is a study. It's a huge database that actually we have to go and they check and evidence and form the documentation in order to arrive at the arm's length price.
Thank you.
And the last question for the gentleman on the back left, please.
Yeah, good afternoon. My question is to Mr. Mohammed.
Can you please...
The microphone a bit closer to the mouth, please.
Yeah, my question is to Mr. Mohammed. Which kind of incomes of free zones companies which are subject to corporate tax?
Which are subject to corporate tax?
Yeah.
Yeah, so most probably, if you are dealing with mainly mainland, as we discussed in the first session, that it is really most probably what constitutes a qualifying income should be income from a free zone, income from, or foreign income from outside the country, potentially the income or passive income, so any dividends, capital gains, and others. These are all will be considered as qualifying income. This is our expectation, considering the consultation document that was issued a long time ago. So what is else? So you will find that income from mainland UAE. So if it is an income that you are receiving from a related party in the mainland, however, you are also considering the other condition in the 5 conditions that we have. So you are maintaining transfer pricing documentation with your mainland entity, then expectation that this will be also considered as part of your qualifying income. This is an assumption that actually we are considering. But if you are receiving an income from a third party, this will be the trick. This will be the point where we will be considering that it is not a qualifying income by all means. So income from a third party and income generated from a free zone, from a mainland, this is, really considered to be non-qualifying income, and it will be subject to 9%.
I think that's a wrap, but I must say, lots of questions, really, really insightful. So Mohammed Al-Swefri, partner from Ernst & Young, Brian Mulholland, Chief Financial Advisor, National Bank of Fujairah, Ben Phillips, Senior Associate, Baker McKenzie. Thank you so much. Give them a round of applause, ladies and gentlemen. And once again, it's been a fantastic turnout, so thank you for everyone who's actually made the time to come to this National Bank of Fujairah knowledge series. And I think we need to do a lot more of these sessions, actually. This is the pre-one, we're going to do one post-June and maybe another one, but thank you very much.
Thank you.
Mr. Gavin.
Thank you very much. Thank you very much, gentlemen. I think a very interesting and lots of questions that are going to come out of that. Obviously, Mohammed, very much in demand. I think, if anything, there was probably 3 points out there that were important, which was preparation, education, and how do you do it efficiently, whether that's through technology, whether that's through operational. So again, thank you very much, gentlemen. I'd just like to invite back up now Mr. Adnan Anwar, just to give some final remarks to the audience. Thank you.
Thank you very much for being here. At least I found it quite useful in terms of, I guess what I can summarize, the call for action. I think 30th June is not far, and even 1st Jan 24 is also not far. I think what I also noticed, the call for tax governance, it sounded more like who will be responsible if something goes wrong. But I guess leadership in our businesses have to be taken from this room so that we are prepared ahead of time. And there are certain actions, as I picked up when Ben said that still we are only exposed to 5% VAT. So there are certain things which still can be done faster in this short window if we are able to plan and decide with our stakeholders better and faster. So thank you again. I hope you enjoyed the session. Please give us your feedback. It's important for us whether these sessions are helpful, any topics which you can share with our marketing team or our business teams, because our intention is whichever shape and form of this thought piece or knowledge series, we can expand and be truly partner to you people in your successes. And before I leave, please join me to again give one round of applause to our partner Refinitiv and all the panelists and the speakers for today. Thank you very much.